Hi, everyone. Welcome to the September 2025 edition of Student of the Market. At THG Retirement Solutions, we break down the noise. We provide a clear monthly snapshot of the market so that you can stay informed and focus on what matters most to you. As always, I'm going to try to keep this short. So if you want more information, please reach out to our team directly because there's a lot going on. Jumping into employment data, as you will see, a hot job market is cooling and becoming more balanced with job openings declining and unemployment rising. You will see that recession odds sit at a year-to-date low at 11%, which is very important in our outlook. This week, the Fed lowered the Fed funds rate by 25 basis points, but it is important to note that the Fed funds rate is still greater than inflation and has been this way for the last 2 years. This should allow the Fed flexibility to continue decreasing rates slowly. You may have heard the saying, don't fight the Fed. Well, historically, when the Fed is easing or lowering rates, while the Fed funds rate is higher than inflation, and the recession outlook is low, as you saw in the previous slides, this is a positive sign for the stock market. So at least in the near term, we still really like equities. There's a lot of cash on the sidelines. We don't see all this money coming into the market, but as rates continue to come down on the short side, we think a portion of this money will be reallocated into higher risk assets. You will see here in the gray box in the middle, as of the end of August, there was little difference between the 10-year US Treasury versus the 3-month US Treasury. As the spread widens out, we think there'll be more money shifting out longer term. Well, we just had the Fed cut, so what happens now? Bonds as an asset class have historically performed well when the Fed resumes cutting rates. However, long-term bond yields don't always fall in tandem with short-term rates. The key takeaway is not all bonds behave the same. Diversification within fixed income matters. Aren't we in September? September has historically been the weakest month for US stocks. We are halfway through September as I'm recording this, and things are looking good. Why aren't we hearing as much about the Magnificent Seven? The Mag 7 has pulled ahead slightly in 2025. The returns of these 7 stocks were just amazing in 2023 and 24, but they are much more in line so far this year. This highlights the importance of diversification. We talked about all the money in cash, so make your cash work for you. Over time, holding too much cash can erode purchasing power. Over the last 30 years, $10,000 in cash lost over half its value after inflation. Meanwhile, stocks grew after inflation by over 800%. As a final takeaway, markets continue to move fast and headlines can be noisy. Staying diversified, understanding the big picture, and keeping a long-term mindset is how you stay ahead. If you have any questions or want to talk through what this means specifically for you, please reach out to our team here at THG Retirement Solutions. I look forward to talking to you next month.